Well, bond yields have gotten so low that even an index of high-yield bonds recently paid less than 5%. What's an investor to do at this point? Here to talk with me about that is a member of Barron's top financial advisors list, James Moriarty from Morgan Stanley in Chicago. You manage money out there for high net worth families, correct?
I do, Jay.
Good. So what do we do here? Where do you get yield? I mean, Treasury yields are low. Junk bond yields are low. Everything I look at is low. What are you telling your folks who are looking for yield right now?
Well, I mean, I tell you, that is a conundrum that faces investors across every spectrum of wealth. And we are in such unconventional times because, as you know, our rates domestically are being artificially suppressed through Fed intervention, quantitative easing, et cetera. And frankly, central banks around the world are beginning to take pages from our playbook. So what we tell clients to focus on is really creating yield and cash flow in other areas of their portfolio. You can get 75% of the 10-year Treasury yield with the S&P 500 right now. That's a very easy place to begin. I believe when I look at fund flows, which is a great lagging indicator, I believe that the retail investor is still massively underweight equity. And they need to come back to equity to basically bridge the income gap that exists now as their old bonds mature. Within fixed income, we're looking at unconventional opportunities.
Okay, so this would be something for that high net worth investor that has access to a lot of different non-traditional asset classes. What are the kinds of things out there for that investor where you're seeing some good deals or relative good deals right now?
Well, you know, the problem in the fixed income market is that, as you know, you just alluded to it in your opening comments, high yield spreads have become massively compressed. With the Merrill Index trading south of 5%, we're in uncharted territories, even with our low level of nominal rates. So we found three opportunities that we think provide very good value. The first is in high yield municipal bonds. Okay. Rating agencies, just by virtue of supply and demand and the factors, secular factors that have affected that industry, have backed away from a lot of the smaller and mid-sized municipalities because it doesn't pay to assign a rating to those bonds, and institutional investors aren't paying for them. Okay. So to find managers that are really doing their homework, we think provides great absolute value, and if you're in the highest tax bracket, it's massively compelling.
So high yield munis.
High yield munis. The second is mezzanine debt. We had terrific success in 09 and 10 in buying mezz debt, particularly mezz debt for middle markets companies. You saw that bank lending has increased 10% year over year last quarter. That's a sign that maybe we're getting into the mid innings of that game. But middle market banks and small banks in the Midwest, where I'm from, are not lending to their traditional clients, and private mezz debt funds are a great way to avail yourselves to that. And then the third opportunity is one that we absolutely did terrific with domestically in 08, 09, and that's distressed credit. You've got a lot of stories that are broken for legitimate reasons, but you've got a lot of other asset-light businesses that are distressed and in dire need of cash and can't access it through traditional channels.
And that's something where you really need a specialty manager out there to go and pick opportunities for you, I suppose.
Yeah, I think, I mean, certainly for mezz debt and for distressed credit, you want to hire a pro. I think certain investors might be able to tap into their own knowledge in local municipalities where they've got comfort and they know that bonds are well covered, et cetera. But for the latter two, you definitely want to outsource to someone
and for the ordinary Joe and Sally saver out there who might not be your client, but who's worried about bonds right now, sounds like it might be a good time to shift a little bit of money from bonds into stocks if they've got a lot of bond exposure here.
Absolutely. You know, the question you asked before, the question that I get most frequently from my clients is, you know, where are we in the U.S. equity cycle? It's 16.5 times forward earnings. We don't think the market's cheap, but we don't think it's expensive. You know, we got to 25 times in 2000. That was an aberration. We got to about these levels in 07, but the market became unglued not because of valuations, but because of a debt crisis. So in this interest rate environment, we think valuations can expand. First quarter earnings were great, you know, up 5% year over year. So we're comfortable that corporate America can deliver the numbers that justify the multiples or even an expanded multiple.
Stocks continue to look like a good deal relative to bonds.
Stocks look good. There's a rotation to late cycle stuff, which is to be expected. I think smaller cap, mid cap stocks look rich, 22, 23 times earnings for the Russell 2000. But internationally, I mean, I think you need to take a look at Europe. You need to have exposure to Japan. We are the only major equity market that made new highs last year. Every other market has got quite a ways to go.
Okay, great. Thanks for taking the time to speak with us, Jim.
My pleasure.
Thank you.